Welcome to Coldplay. It's the Coldplay camp. We're together. Welcome to our TF Team podcast series from dollars to dreams. Is it dollars to dreams,
I like
dreams to
that.
dollars? Doesn't matter where we go.
Dreams to dollars, dollars to dreams.
Either
That's
way,
good.
we're gonna get
It's
the
good.
success, right?
Yes.
So we're here, of course, because news is out, and we want to talk about it. Of course, many things happening that could affect your financial situation, and because we are always here to help you with your financial situation, and we always have the man with the plan on my right. He didn't plan to be caught on Coldplay's camera, though. All right.
You'll never catch me on Coldplay for one.
What are you talking about? They were in Toronto. Weren't you on the camera?
No,
Okay.
no. That's not me. That's your twin.
Well, we're talking about numbers of inflation 1.9 compared to May's 1.7. What does that mean? Bank of Canada is going to hold rates.
Yeah, so it's not that bad, right?
not
So
that bad.
so typically, the Bank of Canada, they've got an inflation rate target of between 2% and 3%.
Yeah.
Sorry, my bad. 1% and 3%.
Yeah.
Right? They like it to be in the middle, 2%. And this is where we're basically at 1 point now.
Yeah.
The only kind of disturbing thing is that if we look at core inflation, so these are the things that really impact you and us, like groceries and things of that nature. Inflation is pretty much around 3%, right? So which is kind of the high end. So as a result of that, the Bank of Canada, they were thinking of lowering interest rates, so they're just gonna go on pause. And plus, our neighbor to the south, we never know what's
Yeah,
happening.
because I saw he was pushing for rates to come down in the U.S. He was going to fire the chair
Powell.
of the Fed. But with him pushing for rates to come down, does that push Canada to bring its rate down as well? Because the Canadian dollar is not doing as well.
That's right.
Against the U.S. dollar. Might
That's
not be a
right.
bad thing.
No.
Right?
I mean, it all depends on which side. Are you an exporter or are you an importer?
Yeah.
If we're exporting, which we want to export our goods, the Canadian dollar being low is not necessarily a bad thing. But if we're importing, it could be a bad thing. So, you know what? Whatever the U.S. does, they always say if they sneeze, we catch a cold, type of thing. So yeah, we've got to be cognizant of that, and I think Carney is cognizant of that, and the Bank of Canada is also cognizant of that. So yes, if they do lower interest rates, then we may also follow suit, but within reason, right? So it all depends on inflation. It all depends is what could we do to stimulate our economy. I mean, you've told me there's projections out there that we may lose 100,000 jobs, right? In Canada. So what can we do to protect that?
that could spell for us the R word.
Recession.
Right? And if the R word is there, and with the other headline that we haven't mentioned just as yet, when mortgage payments are expected to increase in 2026 for almost 70 to 80% of borrowers.
Yeah, a good chunk of their mortgages are, I mean, a good chunk came due this year, 2025. And then next year, there's another significant portion that's going to come due. And guess what? If we go back about 5 years ago, you're looking at mortgage rates of about 2%, and if you're really lucky, maybe even below 2%. And then now, if you're going to renew, you're renewing around 4.5%. So that's double what it was, 5 years ago. So you want to expect that your mortgage payment will be potentially higher.
So that would mean that you might want to, let's say your mortgage is up for renewal in 2026, you might want to start saving a little bit now so that you can capture that early prepayment maybe, try to pay down as much as possible of the principal.
Big time.
So, you need a plan for that. Of course, that's what we're here for.
Exactly.
So that you can have that money set aside instead of going to Florida.
Who's going to Florida? Only the person to my left. I would be going to
sunshine-
Calgary.
the
I
sunshine
would be
state.
going to Calgary and see my family members if I were you in Calgary.
so I'm
So
going-
your sister is in Calgary.
I'm going
He
to Florida.
doesn't love his sister. He doesn't love his sister.
I'll go in the winter when the ticket prices are a little bit more affordable to go to Calgary. But the reason I'm going to Florida is for research. The tariffs on this side of the border, the tariffs on that side of the border.
That's what you call it.
Who is more affected? It's all about for our listeners. So I'm going for a research purpose.
Stay tuned. Stay tuned. Part
Right?
2. We'll
That's
see.
right. I'll go to the supermarket and I'll say these are the prices. All right, and I'll do one here.
He'll go to the liquor store and say these are the prices, and never come back.
Right? So I don't know though, because the Canadian dollar is not going to go a far way in the U.S. But what we, with the decrease in travel, this is where you might get a cheap getaway. This is all in planning, right?
You're absolutely right. I mean,
I did book my travel insurance.
Excellent.
All right.
Excellent. So you paid attention to
I paid attention to our
to what
episode.
we've talked about. I mean, it's all also, like you said, in terms of planning, whereby right now the Americans are trying to lure us with with many deals. So if you have to go to the U.S., I mean, I'm kidding here because it's family. Family is the most important thing. And if you have to go to the U.S., there's a whole lot of deals out there, especially in Orlando, because we saw Florida about a quarter, 25% less traffic of Canadians there. So you might find some good deals.
There you go.
Yeah.
There we go. So all of this is that we're designing this. I could have taken this trip because I had an intention, I had a plan in place that you set aside a certain amount of money. The same goes for when your mortgage payments are going to come due next year in terms of an increase in that. How do you budget? So maybe you need a financial plan or a diagnosis where you can redirect your spending so you can be able to cater for that.
Exactly.
Not when it shows up.
No, you're right. I mean, even if you accelerate, there's a thing at the banks where they talk about accelerating your mortgage payment. So even if you were to increase your mortgage payment by $10, $25, or even better, if you can, $100 per month. Just $100 per month, it will have significant impact on the amount of interest on your balance, because that extra 100 will go towards attacking the interest and the significant portion of the principal.
And then even I think I think I learned this in one of our classes where you can do, instead of we do bi-weekly payments, we do a payment where you do every 2 weeks, which means that some months you might be doing an extra payment.
Exactly.
No fault of yours.
Exactly. So just like someone, you have twice a year, you get 3 pays.
That's right.
So the flip side, twice a year, you're gonna pay 3 mortgage payments if you're paying bi-weekly. But those 2 extra payments are attacking the principal. So you probably don't want to go monthly if you're looking at having a mortgage. You want to go either weekly accelerated or bi-weekly accelerated, so you can pay down. Because if you don't, the sad reality is that's how the banks make all their money, right? So you would have paid over that house 2 or 3 times over if you're paying monthly over a 25-year period.
That's right. So you want to do as much as accelerated. So this is accelerated payment. So this is why working with a team of financial advisors, these are the advice that they can be provided. Right?
We could tailor, like, just increasing. We did it recently. Increasing someone's mortgage payment by $100 per pay. We saved her about 3 to 4 years of amortization period. So instead of being finishing in 25 years, she would be finished within 22 years. So we saved about 3 years in interest costs.
And we've talked about this over the last couple of weeks. Debt is on the rise for a lot of young Canadians, and if you're looking to consolidate or have a plan to deal with your debt, that this is what the team is here for and to help, right?
It's funny. And when it comes to debt, now that I'm older, and I don't know if it's wiser, but the one thing people
You're bolder.
That bolder is probably
bolder.
right. People go into debt for the strangest reasons. One thing you want to avoid: you don't want to go into debt to go on vacation. You don't want to go into debt if you don't have to buy a depreciating asset. I just had a client we're having a conversation now. She wants to buy a new car, which is great. If you could afford it, by all means, but a car is a depreciating asset.
That is correct.
So within the first year, it's going to go down by 20%, and within the 4 or 5 years, more than half of the value of the car would have evaporated. if you gave me your money and I invest your money and I lose half of your money, are you going to be happy with me?
Of course not.
Yeah, so
I'm not even happy if I lose 25.
$25, right? let alone. So why are we going into such an investment? But I get it. When I was young, I wanted that flashy, that flashy car. But as you get older and you kind of realize it, what are you trying to prove?
Yeah.
Is it for you or is it for somebody else to say, oh, Pierre, he must be doing very, very well because he's got a flashy car? And the reality, everybody has a flashy car nowadays. It's not that expensive to on a lease payment or on a financing payment to get a flashy car. If you want to get it because it makes you feel good, it's not a status symbol per se, then by all means. If not, it's probably one of the worst investments you're ever going to make. So if you're gonna buy a car, wait till about that the car has been it's pre-owned for about 2 years or 3 years. You'll probably get a good deal right now on a 2021 2022 vehicle, which has all the bells and whistles that you would need. So yeah, just be careful.
That's right. Yeah, and it's funny that you talk about a car because I was asked that question. What's your dream car? Right? And my response was one that I can get in probably 5, 7, 10 years. Right?
Yeah.
That's my dream car. It's not a fancy model or anything of that.
The reality, when I was growing up,
Yeah.
Cars were made to last.
Yeah.
Right? You were lucky if you got 2 or 3 years out of it.
That's right.
Nowadays, any car, you name the car, it should last you at least 10 years.
That's right.
Right?
That's
10 years and about 300,000 kilometers, right? So they're built to last. So if you're buying a used car, right, that has 100,000 kilometers, you still have another 200,000 kilometers to drive that particular car. My last car that I drove to the ground, 500,000 kilometers.
Oh my God.
That I drove.
Where do you drive for 500?
You don't want to know.
Kilometers.
You don't want to know. Not to a Coldplay concert. That's for sure. That's for sure.
That's right. That's a good point to end on, right? Know where you're driving to. Know where your investments are going.
Exactly.
All right. And that's why we're here to have a plan so that we design that plan. We don't leave you there. Of course, we will check in with you time and again. And this is where you can start. We always say the best time to start was yesterday.
That's right.
So always start with a plan with the team, TF team, where we transform your dollars into dreams.
You kill me.
That's all for today on our episode. Thank you for tuning in. Hope you have a wonderful rest of your day. Take care. Like, subscribe, share. Bye-bye for now.